Hi there, welcome to Kneppy Invest. It is time, because it is the start of a new month, to do an update to the performance of 3 portfolios. In fact, this is the 7-month performance update of these portfolios. I began tracking these particular portfolios at the start of the financial year. Just wanted to see how they perform against the market. And the whole point of being active investors, or in fact, one of these portfolios is a more passive strategy. But the only reason we want to be more active, invest in individual companies, not ETFs, is because we believe we can beat the overall market. If we can't beat the overall market, we may as well just put our money into ETFs. That's a definite investing strategy for some people out there, particularly those who don't find it enjoyable researching companies and buying individual stocks. So let's get stuck into it. But before we have a look at the performance of these portfolios, for those who haven't seen this type of video before, just a few facts in regards to the particular portfolios I am tracking. Towards the end of last financial year, I did ask the viewers of this channel to give me 3 companies they thought would outperform the market over the next 5 years. I collated all the responses and I came up with a group portfolio of, I think it was between about 25 and 30 companies. And this whole strategy was I would not trade in or out of this portfolio over the next 5 years. So this is a completely passive strategy. And the reason I just wanted to test this is because I have heard from a few experts that this is the most successful strategy you can have. Just be completely passive. Once you buy into a company, don't sell it in the future, no matter how it performs. So that is a strategy we're using for this group portfolio. And then I'm also tracking 2 of my own personal portfolios or strategies. All these portfolios use different strategies. The first one is a personal long-term buy and hold strategy. And this is the sort of strategy I began with as an investor well over 10 years ago. Find companies you think will outperform and become bigger over the next 5, 10, 20 years. Buy into those companies and don't really care about how the share price moves in the short to medium term. We only care about how the share price acts in the longer term. Now, the second personal portfolio is using a little bit of a different strategy. This is all based off short-term sentiment. And I started to test this strategy quite a few years ago on a very, we'll say not too regular basis. So here and there I would use this strategy. But over the past few years, I've started to use strategy a little bit more and more. And in fact, this strategy has really begun working well for me. And I tracked this sort of strategy in the last financial year, and it did really well in financial year 21. So, and the other reason is I think it does suit my personality. And that's very important, is trying to find the investing strategy that suits your personality. So this is just using psychology, using the sentiment of the market to buy and sell out of companies or stocks. So the first company we're going to look at the performance update is the group portfolio. Although getting a little bit ahead of myself, because first thing I usually do is look at the overall market. In this case, just the XJO, which is the ASX 200. And this is the monthly chart. In fact, it goes back 40 years. So in a way, this is sort of the time frame you would love to hold a company for, particularly if the company's share price is or has the same sort of look as we see here with the XGO over the past 40 years. In fact, the XGO has climbed from about 400 all the way up to 7,120. So nice compounding return for the XGO over this time frame. Now, in saying all that, equities have seen a really strong tailwinds over the past 40 years with decreasing interest rates. And I don't think a lot of people are really paying attention to that these tailwinds have come to an end. We won't see interest rates fall over the next 40 years. In more likelihood, we will see interest rates rise over the next 40 years because they really can't get any lower than now. So these tailwinds we've seen in the equity markets over this time period have come to an end. But in saying that, generally the markets will rise over time. Now you will see periods, if you go back 100 years, 120 years, there are periods where the share market just goes sideways. In fact, the Nikkei and the Japanese markets hit their high around 1990 and they still haven't got back to those highs. For the XJO, we saw a nice increase in the XJO between 2003 and 2007, or the start of that year, and it reached a high of 6,800 in the middle of 2007, and the XJO didn't get back to that high until just around or just before COVID-19 financial panic, and it's actually gone past that high in the past 6 to 9 months. But the main thing here is there is a long-term trend, and that long-term trend is represented by that sloping blue line. This goes all the way back to the early 80s, and the XGO does hit that long-term trend on occasion. Hit it back in 91, 93, and again in 93. 91 was around the last recession, the recession we had to have, as Keating says. We also saw that long-term trend hit at the bottom of the GFC. That was in the start of 2009. It also hit it during the COVID-19 financial panic and bounced off it really strongly. So we have that long-term trend, and if we ever see the XGO hit that long-term trend in the future, that would be a sort of a situation you might go all in. Now, since the end of the GFC, we've been in this channel, which is represented by those two sloping orange lines, and generally we've been inside that channel over the past 12 to 13 years, except during the COVID-19 financial panic, but we're just below that channel for a very brief period of time. And recently, in August of last year, we hit the top of that channel and we've started to pull back again. So this channel hasn't been broken yet. There is a possibility we could go to the bottom of the channel over the next few months, maybe 6 months or so, depending on how quick we might form. And I should emphasize that word, might fall. Doesn't mean we will go to the bottom of the channel, but if we do go to the bottom of the channel, the XGO could reach about 64 to 6,500 when it does get to that bottom of the channel. So there is still some potential downside from where we are now. Before we have a look at how the group portfolio is performing to the end of January, or actually to the end of trading on February the 4th, let's just go back to see which companies were doing all the heavy lifting at the end of the first half of the financial year. And this is really important because the group portfolio was up $15,000 at this point, or 15%. But all the heavy lifting, or the majority of the heavy lifting, were done by two companies, Novonix and Lake Resources, and the majority of the companies in the group portfolio were actually down for the first half of the financial year. So let's have a look at how the group portfolio is now performing to the end of trading on February the 4th. Now, the overall market was down a lot in January. I think it was down about between about 4 and 5%. And group portfolio also was down about 5% as well, down from 15,200 or whatever it was to 10,200. Now, Novonix and Lake Resources, which were doing the heavy lifting for the portfolio up until the end of the first half of the financial year, both did experience a pullback. But there was another company that rose to the top in a pretty quick fashion. That was Brainchip. In fact, the returns for Brainchip went from just over $1,000 to $10,200. In fact, if Brainchip didn't perform how it did, the group portfolio performance at this point in time might be just above $0. So go Brainchip. It really held up the group portfolio's performance during this month, even though it was down a fair bit. Now you can see here that there are even more companies now are in the red, and in the previous month, at that point in time, we only seen 4 companies that were down over $1,000. Now we're up to 8, and those companies are Credit Intelligence, Pointera, Megaport, which didn't really have a good month, didn't have a good Appendix 4C, Imogen Biosystems, Tezzeret, Alcidion, Zip, and Kogan also released a fairly negative, they released an update and the market did not like that update and we did see the share price of Kogan for a fair bit. Also, Ares Resources is down 923. So even though we've seen a lot of companies in the red here, it's just because of Brainchip, Novonix, and Lake Resources. Only 3 companies in the portfolio, and those 3 companies have performed absolutely steadily since the start of this portfolio in July of 2021. And of course, we want to compare the performance of the group portfolio to the overall market, and my proxy here is the STW, which is the ASX 200 ETF. So if you don't want to put any time into stock picking, you just put your money into an ETF like STW, and the returns you would have got from that over the past 7 months is negative by 0.04%, capital gain a negative 3.08, but you would have got a fair bit of dividends, 3.04% of dividends, and the group portfolio up 10.2%, which includes a 9.14% capital gain and a 1% dividend. So at this point in time, the group portfolio is absolutely smashing the market. Now to my own personal portfolios, and the first one we'll look at is the long-term buy and hold portfolio. Now, buy and hold is not exactly true because I'm not this sort of investor who buys into a company and I want to hold it forever. I will sell it if I think it does become overvalued or if I think the trend might be shifting against me. And in this particular quarter or month, I have become a little bit more bearish with the overall market. So I have decided to go a little bit more to cash, not completely into cash. I think that would be a mistake. But I did sell 4 companies. They were Australian Clinical Labs, which I did think became a little bit overheated, and there was a little bit too much hype in that company. So I decided to take some profits. Also sold out of Ambitech. They had a negative report or results in or some sort of update well over a month ago. Decided to take some profits in that company. Also decided to take profits in ReadyTech. That could be a mistake because I do like the future of that company, but the trend had shifted to negative, and so the sentiment has become a little bit more negative as well. So I decided just to take some profits with that. With the run-up of Brainchip, I decided to sell out a little under half of my shares. So had about 4,250 shares. I decided to sell 2,000 shares just to lock in some of those profits. And more than likely, those other shares I do have, which amounts to well over 2,000, I more than likely won't sell them out no matter what happens with the share price of Brainchip moving forward. And I did make one acquisition. This was fairly late. In fact, this was after the end of January, and that was in Playside Studios. And there's a couple of reasons I bought into that company. They did release a good quality result, which I will talk about in a video, a standalone video or a dedicated video for the company. And just some of the things they are doing, I think it's in really big growth areas. So I took a small position, initial position in that company, only $2,000 worth, and potentially I will add to that position in the future. But overall, because I did a little bit more selling than buying, I grew my cash on hand to $28,620. So if I become a little bit more bullish, I will buy in some more companies or add to positions in some companies I already have. Or if I come a little bit more bearish, I definitely have a few companies here I am thinking of selling out of. Now, just to the performance of the portfolio itself on the left-hand side here, because I have sold out a lot of companies just by taking profits, including Australian Clinical Labs, Ambitech, Brainchip, and ReadyTech in the past month. When you look at the companies currently in the portfolio, overall it is down $2,500, and quite a few of the companies in the portfolio are not performing at this point in time. I'm actually fairly disappointed with some of the companies' performance and disappointed with what some of the management have done with these companies. For example, Sydev did a capital raising, which I thought was horribly timed. It was one of the worst timed capital raisings you could have done. Now, in saying all that, there's a few badly performing companies here: Electro-Optics, Orbital, and Xtech, maybe even lump Sydev into that as well, that I think have been significantly affected by COVID-19. And once the world opens up, I think these companies will perform really well at that point in time. So I'm not willing to sell those companies just yet, even though the share price of those companies are in a well-defined downtrend. And even though those companies are not performing well, quite a few companies have performed well. I've locked in profits of some of those companies, and overall, the performance of this strategy has worked well over the past 7 months, up 12.53%. And when you compare that to the STW or the overall market, you have to be, or I am happy with the performance of this portfolio and this strategy. So even though some of these companies have not performed all that well over the past 7 months, doesn't mean they're going to perform badly over the next 7 months. In fact, laws of average tells us those companies that don't perform over a certain period of time are the ones more likely to perform better over the next 7 to 12 months. So I'm looking forward to see some of those companies that are highly down over the past 7 months to be my best performers in this portfolio over the next 6 to 9 months. Now, although I am going to a little bit more cash in my long-term buy and hold portfolio, because in that portfolio, I do try to gauge overall sentiment in the market. And if I'm a little bit more bearish, I'll go to more cash. If I'm a little bit more bearish, I try to get fully invested or towards fully invested. So gauging overall sentiment in the market is important for that particular portfolio or strategy. Now, when I'm talking about my short-term sentiment portfolio and strategy, sentiment in the overall market is something I don't really worry about, because this is sentiment about individual companies. And sometimes when there's negative sentiment in the overall market, you can see positive sentiment in individual companies. So this is all about looking at sentiment in individual companies. There's a very important distinction there. So I actually did make quite a few acquisitions in the past month, even though I am bearish with the overall market. Those companies I did buy during this particular month: Telstra, AGL, Comply Fintech, Capricorn Metals, Revison, and Pac Gold. Quite a few of those companies are up already, even though the overall market is down, including Pac Gold, Revison, Capricorn Metals. AGL's up. Telstra's down a little bit from when I bought it, but that was just bad timing. So overall, I did make $18,256 of purchases, more heavily weighted towards Telstra and AGL, the more mature companies. And I did dispose of one company, and that was Clover. So that was only $2,200, and the trend had just shifted to negative in that company. Now, overall, cash on hand is still at $27,649.07. Now, there are a few companies here that I am thinking of selling out of, including Northern Star, EML Payments, possibly even CSL, Treasury Wine Estates. Those 4 companies, the trend is negative, and there is a bit of negative sentiment in those companies. Now, as Northern Star, I might be thinking of holding on to that company a little bit longer, even though the trend is down, just because I am fairly bullish on the long-term future of gold. Best performing companies in this portfolio have been, for quite a while, Johns Lyng Group, South 32, and OFX Group. In fact, South 32 I've held for about 16 to 18 months, and the share price just keeps on increasing. A very slow burn sort of increase. But that's the sort of increase in the share price I do like. Neuron Pharmaceuticals, that has been a good performer since I bought into them. TPC Consolidated, Pac Gold, Revison, and AGL Energy all are in the black at this point in time, including Capricorn Metals, but I just bought them 2 days ago. So the whole point of this portfolio is just look at individual companies' sentiment, and if the sentiment shifts to negative, that's the time you sell out. And if the sentiment remains positive, you just keep on holding, and that's what's happened to those best performing companies in this portfolio. I tested this strategy in financial year 21, and it significantly outperformed the market. And as soon as we got to the start of this particular financial year, I sort of neglected this strategy or this portfolio for about a 4 to 5 month period. And in fact, at one point in October, November of last year, the performance of this portfolio underwhelmed. In fact, it was lower than the overall market. And as soon as I saw it was lower than the overall market, I decided to spend a little bit more time in this strategy. And as soon as I started spending a little bit more time, that's when we started to see this portfolio's performance outperform the overall market. And at the end of February 4, this short-term portfolio had an overall return of 3%, which was better than the overall market, but not as good as my long-term strategy. So I do want to spend a little more time on this strategy. I am figuring out certain rules. I want to come up with a list of rules to follow, and I don't want to break those rules. So that's my strategy. Come up with some specific rules, follow that rule book, and then hopefully we'll see significant outperformance with that sort of strategy. And hopefully, this is my hope, that strategy will outperform my long-term portfolio, because I think this particular strategy suits my portfolio to a T. Now let's compare the performance of all these different strategies to the STW. In fact, the STW is down. The only one in red at this point in time. At the end of the December, the half year, the STW was up nearly 5%. So a really bad month we saw in the overall markets, and we all know that at this point in time. The group portfolio fell from 15.22 to 10.19%. My long-term portfolio fell from 16.71% to 12.53%, and my short-term sentiment fell from 5.5 to 3.03. By this point in time, all three portfolios are absolutely destroying the market returns, and that's what we want to see, because again, if you can't beat the market returns, you might as well just put all your money into an ETF and then just go to the beach all day. If you want to go to the beach all day, I wouldn't want to do that. I like doing this. So I like researching companies. I like picking individual stocks. That's something I really like doing. And even if my overall returns in the strategy I use were slightly beating the market, I would still be doing this, even though you do have to spend a fair bit of time doing the research, fair bit of time looking at charts, that sort of thing. I just like it. And I think that really helps. If you like doing that sort of thing, it really helps. And even when we do see this negative sentiment in the market, a lot of people out there are freaked out, not getting any sleep. That doesn't really affect me, just simply because I like doing it. So I always have goals, and these are my goals for February. I still want to deploy a little bit more of my short-term cash, because I have about $27,000, but I want to use a little bit more patience. It's one of the things I'm trying to learn more, and that's patience. Just because I see a possible buy or sell doesn't mean I need to hit the trigger straight away. I can just remain patient and get confirmation about that buy or sell. I also want to further develop my sentiment strategy. And this is me developing some rules so I can follow those rules, take the emotion out of the trade. So those are things I'll be working on for February, and more than likely those goals will continue into March, April, maybe even May. That's all I have for this 7-month performance update for these three portfolios up until February 4, so not completely to the end of January. If you do have any questions about anything I've said in this video or any companies I've mentioned, just leave in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. And thankfully, I finished this video because there is someone doing or using a whippersnipper outside, and it's getting a little bit noisy. So hopefully that's not coming up on this sound in this video. Have a good day. Talk to you later. Bye.